Did you know that contributing to an IRA is one of the best ways to save for retirement? Whether you are just starting to plan for your golden years or you're a seasoned pro, there are always new things to learn about this powerful retirement savings tool. And well, one of the best features of IRAs is the fact that there's so many possibilities available. You have many investment options and can choose an IRA from practically any bank or brokerage. It's definitely worth considering because of its versatility and tax advantages. So in today's video, we'll take a deep dive into everything you need to know about IRA contributions, from how IRAs work to the different types of IRAs available to the rules and regulations around contributions. Well, we've got you covered. So without further ado, let's get started. Opening an IRA might be a wise retirement planning decision, and this is how it works. Imagine choosing between using the easy pass lane or stopping to toll booths every 20 miles as you drive down the highway. It can be comparable to using an IRA rather than a conventional taxable brokerage account. You'll get where you're going more quickly and avoid having to stop at the tax toll booth every year. When you start an IRA, you can invest your contributions in various securities such as stocks, bonds, and certificates of deposit. Unlike a 401k, where your investing selections may be limited, you have unlimited control over your money with an IRA. But what if you lack confidence in choosing investments for your IRA? That should not be a bother to you. Target date retirement funds and robo-advisors are two low-cost choices that can assist you in achieving broad diversification that is suited to your risk tolerance and time horizon. The key point is that your asset allocation can significantly impact your overall results. No matter when you want to retire, your asset allocation today, how you divide your money among stocks, bonds, and other investments, will make or break your future earnings. In fact, according to some research, asset allocation accounts for up to 90% of an investor's overall return. IRAs also give you the option of changing those investments. You can move in and out of them without paying capital gains taxes, such as switching your money from individual stocks to bonds. It is crucial to remember that an IRA is intended for retirement. Therefore, you cannot withdraw funds without incurring penalties before retirement, except when utilizing the money for exceptional exclusions like purchasing your first home or paying for higher education. You will be subject to taxes and a sizable 10% penalty if you withdraw money before you are 59 and a half. So you must comprehend a few points about IRA contributions if you want to start. But first, you need to understand the different forms of IRAs. The two primary types of IRAs are traditional and Roth. Traditional IRAs do not require paying taxes on your earnings until you begin taking required minimum distributions. And by the way, you probably weren't aware that the age at which you must start taking RMDs was increased from 72 to 73 as of January 1st, 2023. The traditional IRA allows you to accumulate more money over time because it has not yet been taxed and can grow at a faster rate. On the other hand, the Roth IRA demands that you pay taxes today but permit tax-free growth of your profits. Which one's the best for you? The Roth IRA is generally your best option if your future tax bracket is higher. However, there's still more. You haven't probably heard about SEP IRAs. On this one, contributions to retirement funds can be made by employers, typically in the form of small enterprises or individuals working for themselves. Moreover, simple IRAs for small businesses are available. You can even try a self-directed IRA if you want more investment possibilities. Now, hold up. Before we go any further, let me just remind you to subscribe to my channel for all the latest tips and tricks on financial planning and budgeting. And guess what? In the description below, you'll find a link to my awesome monthly budget trackers. So click that subscribe button and check out those trackers. You'll be glad you did. Alright, let's get back to the content. Here's the exciting world of Roth IRA contributions. You must be familiar with the guidelines before making any kind of contribution. You must also be aware of your eligibility for a contribution. If you have taxable income and your income is below a specific threshold, the answer is most likely yes. You can contribute to a Roth IRA. But wait for a second, there are some limitations you need to be aware of. Let's start with the good news. Making contributions to a Roth IRA is not age restricted. That's true. You may still contribute to a Roth IRA whether you're 20 or 70. You're only permitted to contribute a certain amount each year though. The maximum contribution amount for 2023 is $6,500. You can also contribute an additional $1,000 if you're 50 or older. But before you start speculating how to spend that more cash, there's one more item to consider: your wages. There are limits on how much money you can make and still be able to contribute to a Roth IRA. It's really not something complicated to comprehend. If you file as a single person, you can only make the maximum contribution if your modified adjusted gross income is less than $138,000 in 2023. If you earn more than that, your contribution amount gradually decreases until it is eliminated. For instance, you wouldn't be able to make a Roth IRA contribution in 2023 if you were single and your income was $153,000. Then, if you are eligible to contribute to a Roth IRA, you have several alternatives for funding your account. One method being the use of bank transfers. An ACH transfer or another electronic funds transfer can be used to transfer money from your bank account. You can accomplish this by visiting the bank or brokerage's website that sponsors your Roth IRA and following their contributions instructions. You might also think about automatic contributions. You can set up automatic contributions if you want to contribute consistently. You can do this by giving the financial institution that sponsors your Roth IRA your bank's routing and account information. You'll then determine the quantity and frequency of your automatic contributions. You can also utilize a mobile app. If your bank or brokerage offers a mobile app, you can contribute by scanning a paper check and depositing money remotely. Traditional IRAs, unlike Roth IRAs, do not have income limits. You can deduct your contributions in whole if you and your spouse do not have a 401k or other workplace retirement plan. But the deduction can be scaled back or altogether if a plan covers either a view via your place of work. The annual IRA contribution cap for 2023 is $6,500 for people under 50 and $7,500 for people over 50. Traditional IRA annual contribution caps in 2022 were $6,000 of your taxable income, whichever was smaller. By the end of 2022, you may have made a cumulative contribution of up to $7,000 if you were 50 or older. Contributions to a traditional IRA may be tax deductible for some investors. If an employer-sponsored retirement plan does not cover you, and your spouse if married, you may deduct your whole contribution from your taxes. For instance, if you made a $6,500 contribution to a traditional IRA in 2023, but did not have access to a workplace 401k plan, you could deduct $6,500 against your taxes. The same applies if you're married and neither of the spouse has access to a workplace retirement plan. And if an employer-sponsored retirement plan covers you and your spouse if married, your conventional IRA tax deduction may be capped based on your modified adjusted gross income before deducting student loan interest and other tax deductions. Imagine the following scenario. You've been making IRA contributions like a boss, but did you realize that making excessive contributions can result in severe IRS problems? That's true. If you're not careful, you can go over the annual limitations and owe the government a sizable sum of money. This is what happens as a result of exceeding the limit. The IRS will impose a staggering 6% tax on the excess contributions in your account each year. But don't worry, there is yet hope. If you discover your error before filing your taxes, you can withdraw the excess contributions together with any earnings and avoid the tax. However, you might have to pay income taxes on the earnings and an additional 10% penalty on the extra amount you withdraw if you're under 59.5. If you don't notice the error until after you've filed your tax return for the year, you can withdraw the extra contributions and file an amended return by October 15. If you miss the extended deadline, you can still make up for it by lowering your contributions for the following year. However, you'll be responsible for paying the 6% fine until the excessive contributions are reduced. To be on the safer side, always consult a financial counselor or tax expert who can guide you on managing your contributions more effectively. They may advise you to adhere to the restrictions and avoid the hassle of excessive contributions. Keep in mind that it's always better to be safe than sorry when it comes to your IRA contributions. So be aware of these restrictions and make thoughtful contributions. Now that you know more about IRA contributions, you have the tools to make informed decisions about your retirement savings. Whether you prefer either a traditional IRA or a Roth IRA, make sure you contribute what you can and stay within the limits to avoid penalties. So what are you waiting for? Start contributing to your IRA today and watch your money grow over time. And tell us, what tips or strategies have you used to maximize your IRA contributions? We would love to hear your thoughts in the comments below. That's all. Remember to hit the like button and subscribe. See you in the next video.